$23,600. That's what's sitting in this savings account at one of the largest banks in America. Last year, all of that money earned $2.36 in interest. Not $2,000, not $200, $2.36. That's a cup of coffee for lending a bank $23,000 for 12 straight months. The exact same money in a different account with the exact same government insurance sitting behind it would have earned $979 over that same year. That's 415 times more. No stock market, no lockup, no extra risk. One form. Over 5 years, that gap comes to $5,308. And almost nobody finds out because there's no letter, no alert, and nobody at the bank whose job it is to tell you. One quick thing before the numbers. Everything here is general education built on published rates as of August 2026, not advice shaped around your situation. And these rates move, so check the current ones before you shift a dollar. Here's the number almost nobody has looked up. A standard savings account at Chase pays 0.01%. At Bank of America, the Advantage Savings Account pays the same 0.01%. 0.01% means $10,000 earns you $1 a year. Not $1 a month, $1 for the year. You could find that on the sidewalk. Across every bank in the country, the FDIC puts the national average savings rate at 0.38%. That average is being dragged upward by small online banks paying real money. The biggest banks, the ones with branches on the corner and your direct deposit already flowing in, sit at the very bottom of it. And that's not an accident or an oversight. It's the business. A bank that already has your paycheck, your debit card, your bill pay, and your phone app doesn't have to compete for your deposits. It already won. Paying you more would just be generosity, and banks are not built for generosity. Now put a real balance against it. The Federal Reserve's Household Survey puts the typical American household at about $8,000 across checking and savings combined. At the national average of 0.38%, $8,000 earns $30.40 in a year. At the big bank rate of 0.01%, it earns 80 cents. The rate isn't hidden. It's printed on your statement, on a line most people have never once gone looking for. It only starts to sting when you find out what the account across the street is paying for the same money. A high-yield savings account is not a different product. It's the same thing, a savings account, at a bank, with the same federal insurance. The only difference is that the bank offering it doesn't have branches, doesn't have your direct deposit yet, and has decided the cheapest way to get your money is to actually pay you for it. As of August 2026, the best of them pay around 4.15%. Some go higher with conditions attached. One account advertises up to 4.21% if you meet monthly deposit and balance requirements. Others sit a little lower with no requirements at all, around 3.75 to 4.01%. Every one of those is FDIC insured to $250,000 per depositor, per bank. That is the identical protection your big bank gives you. Same insurance, same government, same $250,000 limit. So run our $23,600 through it. At 4.15%, the first year pays $979.40. At the national average of 0.38%, the same balance pays $89.68. That's a difference of $889.72 in 1 year for money that never left a savings account and never took on a day of market risk. There's no penalty for pulling it out, no minimum term, and a transfer back to your regular bank clears in 1 to 3 business days. There is one more place that pays nearly the same, except the rate isn't set by any bank at all, and it comes with a tax break most people have never been told about. A Treasury bill is a short-term loan to the United States government. You buy it for less than it's worth, you hold it for a few weeks or a few months, and the government hands you the full face value at the end. The difference is your interest. The minimum is $100, and you can buy one straight from the Treasury or through a brokerage account in about the same number of clicks it takes to buy a stock. On August 13th, 2026, the 3-month Treasury bill was paying 3.80%. On our $23,600, that's $896.80 over a year, about $82 less than the best savings account pays. So it looks like the second place option. Then the tax bill arrives, and the order flips. Interest from a savings account is taxable by your state. Interest from a Treasury bill is not. Treasury interest is exempt from state and local income tax everywhere in the country. Put a real household on it. A family in California, in the 9.3% state bracket, earns that $979.40 in the high-yield account, then hands $91.08 of it to Sacramento. They keep $888.32. The Treasury bill pays them $896.80, and the state gets none of it. The account advertising the lower rate put more money in their pocket. And the bill does one thing a savings account structurally can't. The day you buy it, your rate is locked until it matures. A savings rate is not a promise. It's a number the bank can change on a Tuesday. When the Federal Reserve cuts, savings accounts follow it down within weeks, and nobody mails you a letter. One of the largest government money market funds paid 5.30% in August of 2024. By June of 2026, it paid 3.55%. The bill you already own keeps paying exactly what it agreed to. So that's four doors: the big bank, the national average, the high yield account, the Treasury bill, four percentages that all sound close enough to ignore until you let them run. Same $23,600. Nobody adds a dollar. Nobody withdraws a dollar. 5 years pass. In the big bank savings account at 0.01%, that money earns $11.80 over 5 years total. At the national average of 0.38%, it earns $451.82. In 3-month Treasury bills at 3.80%, it earns $4,837.98. In the best high-yield savings account at 4.15%, it earns $5,320.67. Top to bottom, that's a spread of $5,308.87. Same dollars, same insurance, same access. The only variable that changed was which building the money was sitting in. Stretch it to 10 years, and the split gets harder to look at. The high-yield account earns $11,840.90. The national average account earns $912.29. $10,928 of difference, and not 1 cent of it came from the stock market. If numbers like that are the reason you're here, subscribing is how the next set finds you. That's what makes this one strange. Every other way to earn $10,000 asks you to take a risk, learn a skill, or wait for something. This one asks you to fill out a form. So why does almost nobody do it? There are 3 real answers, and only one of them is actually about the money. The first answer is that the headline rate comes with strings. That 4.21% account only pays it if you hit monthly deposit and balance conditions. Another bank advertising 4.20% has stopped taking new applications entirely with more demand than it wanted. The number on the billboard and the number in your account are often 2 different numbers, and working out which one you actually qualify for costs an afternoon nobody has.
The second answer is smaller and far more powerful. Moving the money takes about 20 minutes and 2 business days, and it is never, on any given day, urgent. Nothing breaks if you don't do it this week. A $5,000 decision with no deadline attached will lose to a load of laundry every single time. And it does, for years at a stretch. The third answer is the only one that's actually about the money. Interest is taxed as ordinary income, not at the lower rate stock gains get, but at whatever bracket your paycheck already sits in. On $979.40 of interest, a household in the 22% federal bracket hands back $215.47 and keeps $763.93. $763 against $2.36.
Even with the IRS taking its cut first, that's 324 times more money on the same balance. So the tax is real, and it changes nothing about the decision. Which leaves the one question none of the four doors answers. Not where the cash should sit, but how much of it should be sitting in cash at all. The standard guidance is 3 to 6 months of expenses in cash. If a household spends $4,720 a month, that's somewhere between $14,160 and $28,320. Our $23,600 lands right in the middle of that, about 5 months. For that job, cash is exactly the right tool. Above that line, the math turns. In July of 2026, inflation was running at 3.4% a year. The best savings account in the country pays 4.15%, but after that same 22% federal tax, you're keeping about 3.24%. 3.24% against 3.4% inflation. That's a real return of negative 0.16%. The best cash account in America, held by someone in a normal tax bracket, is losing purchasing power slowly. It's losing far less slowly than $2.36, but it is still going backwards. So cash has one job, and it does it perfectly. It's the money that has to be there on a Tuesday when something breaks. It is not the money that's supposed to grow. Anything sitting above your emergency number, month after month, isn't safe, it's just quiet. And if the balance ever climbs past $250,000 at a single bank, the insurance stops there. Past that point, it has to be split across banks, or moved into treasuries, which aren't FDIC insured at all. They're a direct obligation of the United States government, so there's no limit to run into in the first place. So there are really only two numbers to go find tonight. What's actually sitting in your account right now, and what rate is it actually earning? Most people can answer the first one instantly and have never once known the second. If you want to run the next set of numbers with me, that's what the next video is for. Because the money in that account didn't do anything wrong this year. It just sat in the wrong building and earned $2.36.